welcome. Today we're going to be looking into some strategies to help you pay down debt a little bit more effectively. So before we get started, a little bit about UVA Community Credit Union. We are a local not-for-profit financial institution. We've been around since 1954. And of course, our core mission is working together to strengthen the financial wellness of our members and local communities. That's why it's important that we do financial education sessions to help you learn and, hopefully improve your financial health. So, getting into debt, we know that debt can be a huge issue for a lot of people. It can grow out of control pretty quickly for things that reasons we cannot control, such as job loss, death of a breadwinning spouse, divorce. You may have an illness or medical issue that causes um, income reduction or increase in bills. So debt can grow out of control for a wide variety of factors. Some people actually use shopping. Retail therapy is actually a real thing. You get a little dopamine high when you're making that purchase, and it gives you a sense of control. You may have comfort in shopping. So there are a lot of reasons that debt can um, grow to a place where you look at it and you think, oh my gosh, it's too much right now. And that really can cause then mental stress. It can cause anxiety, depression. You lose the ability to focus and concentrate, and it even strains your ability to reach your other important financial goals. So it's important to kind of tackle that debt as quickly as possible. It's costly. We know that carrying debt is expensive. For example, if you have $20,000 of credit card debt at 24% annual percentage rate, and you're paying the minimum monthly payment of 3% of the balance, that debt will take you over 30 years to pay off and will be very costly. $58,947 is what you would pay on that. So that is a huge number. So we know that getting debt under control can not only save you money, but debt also has a huge impact on your credit score. 30% of your credit score is something called your utilization ratio or your usage ratio. This is the amount of revolving debt that you are using over the amount of revolving debt that's available to you. So if you have, let's say, $20,000 of available debt on credit cards and lines of credit specifically, and you owe 10,000 on those credit cards, you're utilizing 50% of your available credit. And that is putting you in the danger zone. It's going to start dragging your credit score down when you reach more than 50%. You're using more than 50% of your available credit. To get your credit score trending upwards, you want to be utilizing and carrying balances of below 30% of your total available revolving credit lines. So by paying down debt, you'll not only save some money, but it's going to give your credit score a little boost. Now, if you have debt distress, you may have some red flags, right? If you are unsure of how you are going to pay your bills, you're only paying the minimum, you're paying bills late, you have cards that are at their limit. Those are some red flags that you may be in debt distress. You also, if you're taking on debt, you may not have savings outside of your work savings. So these are obviously signs of debt distress, and we want to work towards an effective debt management plan. And the first thing, of course, is to stop adding debt as much as possible. If you are in an emergency situation, job loss, medical issues, anything like that, where you may have support resources available to you, we want to encourage you to start applying for any government benefits or anything that may be available to you, emergency resources if appropriate, as soon as possible. A lot of times people will delay starting that process. And it can be a long process. It could take months for some of those government programs and benefit programs to come through. So you don't want to wait until you really do need those resources. You want to get on the application process as soon as possible. I mean, best case scenario, if your situation changes, you can always kind of um, not utilize those resources, but you don't want to be in a situation where you're trying to apply for them too late. So, and it's not a situation where you should be hesitant to do that. That's what those programs are for. So definitely take care of that as quickly as possible and don't delay. You also want to make sure that you're aware of all of your outstanding debts. So we have a resource called Know What You Owe that basically helps people list their debts. You want to know your interest rate, your current balance, your minimum monthly payment, and of course, this is going to help you inform like which payment strategy you're going to select for those debts. So once you have your debts kind of all listed, you know what you owe. We want to try and free up as much capital as possible to focus on paying those debts down. So if you haven't already done this, this is a great time to create a budget or go through your household budget and just make sure that you're not overextending in your wants area. You, you know, 50-30-20 rule is kind of a guideline. 50% of your essential your spending should go towards those essential needs, 30% towards wants, and 20% towards savings. So kind of use this as a guideline to make sure you're not overextending in like maybe the wants area, because that's sometimes where people can get into a little bit of trouble. Look for anything that you can kind of cut, even if it's temporarily. Do you have any unused subscriptions? Are you eating out too frequently? Is your home leaking money through ignored repairs or no good weatherization? So these are all opportunities to look for little spending leaks that you may have in your household. If you can't decrease your spending, so you've come through your budget, you've done what you can to decrease that spending, is there a way that you can increase income? So, or both, right? You can decrease your spending and increase your income, even just temporarily, until you can get that debt under control. If you know that you are getting a tax refund or bonus at work, this is a great time to kind of look to apply those funds towards the debt? Or is there something you can sell so you can kind of get a little bit of income, whether that's like furniture or a skill that you have? Can you pet sit or teach something? So again, this doesn't have to be forever. It's just a temporary change so you can focus all of your financial efforts on paying down that debt. So we also have a resource in GreenPath Financial Wellness. If you're a member of UVA Community Credit Union, you get free financial counseling with a GreenPath certified financial counselor. You just call GreenPath. They're 877-337-3399. It's free. They can help you set up a budget. They can help you set up a debt repayment plan. If you're a member of UVA Community Credit Union, again, it's free. Just you have to tell them that you're a member. If you're in more severe financial distress, again, take advantage of those emergency resources. We do have a kind of brief overview here, but 211 Virginia is a great resource for emergency services in the area. So again, if you're in this situation, we encourage you to look into some of these resources if needed. Now, if you're in a situation where maybe your debt has become overwhelming and maybe you cannot pay your bills monthly, the income's not there for whatever reason, like I said, job loss or medical issues, whatever, if you're in over your head, there are programs that can help you. One thing that you can do is you can contact your creditors directly to see if they can offer any assistance with a workout plan or reduce your interest rate temporarily so you can pay down your balance. What can they do to help you? They also have things called debt management plans where a business can negotiate debt on your behalf. The creditor may agree to lower interest rates, forgive some of the debt, or waive fees. Now, some of these may impact credit because you're not paying as agreed. Even if they take the interest rate off, again, that is not exactly paying as agreed. So it could have a negative impact on your credit. So it is a resource that's there, though. We do have GreenPath Financial Wellness does have a debt management program. There are fees related to these debt management programs. So when you're working with a counselor, make sure that you find out a little bit about that. And if you're interested in pursuing debt management plans, it's important that you understand who you're getting in business with, because usually what happens is you're paying the debt management vendor and they're paying your bills. So you want to make sure you're working with someone that's very reputable there. All right. So next thing we're going to dig into are the debt repayment strategies. Most common strategies that we have, one, the avalanche method. This is one of my favorites because it focuses on the highest interest rate debt first, and it makes the most fiscal sense. So how you're going to employ that is when you're listing your debts, you're going to start with your highest interest rate debt and then list down to your lowest interest rate debt. You're going to pay as much as possible on the highest interest rate debt and the minimum monthly payment on all the others, and then move down the list. The snowball method eliminates smaller debts first. So this is not smaller interest rates. This is like the smallest balance. And this can give you a little psychological win because you're knocking bills off your kind of to-do list, one less bill to pay kind of thing. Now, the snowball, when you're listing those debts, you're going to list the smallest balance to the highest balance and then pay as much as possible on the smallest balance and then move down the list. Now, typically what we do when we're working with folks is, you could take a hybrid approach. I may do a snowball method for like one or two small nuisance bills and then switch to the avalanche method to knock out the more hefty items that are costing the most. Now, if you can, transforming your debt through debt consolidation or home equity line of credit or even a balance transfer offer can be a great option. So let's just go through a quick few scenarios. Let's say Dan has $10,000 in credit card debt and he pays a current rate of 26% annual percentage rate. So paying the minimum monthly payment of $300, he's going to be out of debt in 60 months with $7,928 in interest. So he's going to be paying $300, 5 years, out of debt with, almost $8,000 in interest. Employing some of the tactics that we talked about, one being, you've come through your budget, you've freed up a little extra capital, and you're going to throw some extra money at that debt. If he increases that payment from $300 a month to $400 a month, he can pay that debt off in 37 months and pay $4,560 in interest. Big savings. Now, he could also consider a consolidation loan. If he's consolidating that debt, right now we have a debt consolidation promo that's running 7.74% annual percentage rate. It's just a personal unsecured loan to help people pay down debt more effectively. Let's say qualify for an 8.8% annual percentage rate on that. If Dan continues paying $247 a month, that loan would be paid off in 48 months with $1,900 in interest. Now, that's a savings of, $3,368 if he increases his payment, or $6,028 through that consolidation loan. And Dan can save even more on that consolidation loan, that $247 a month. he can still keep paying $300 a month, right? That's what he was paying before. He can keep paying that, and they'll pay that down even quicker and with less interest. So those are two great money saving examples. A few more here. If he consolidates with a home equity line of credit, let's say a 6.99 annual percentage rate that's fixed, $300 a month, that would be paid off in 38 months with $1,150 in interest. Balance transfers are a little trickier because you have to factor in, sometimes they have a balance transfer fee. Um, and most people have fees of anywhere from 3 to 5%. And they may have special promo periods that end in 9 months, 12 months, whatever. So you have to kind of analyze the particular offer. I used our current offer right now as an example here. It's 0% annual percentage rate for 15 months, 4% balance transfer fee, and then it would convert to the standard credit card rate that you have, 13.49 for our members reward card after that. So by paying $300 a month with that balance transfer offer, that loan would be paid in 38 months with $1,121 in interest. There is a great balance transfer calculator on our website. So if you're kind of not sure if a balance transfer may work for you, I encourage you to just check that out. So by doing those balance transfers, he can save $6,807, home equity line of credit, $6,778. The goal here, of course, is to lower that interest rate as much as possible through refinance efforts, right? The 26% rate, even getting it down to, gosh, that 13.49 is still going to give you a realized savings, even without the 0% offer. That's just a bonus. But getting that interest rate down is as critical as possible. So a lot of times people will ask, well, should I focus on saving money or paying down debt first? What's more important? And typically we'll recommend that you focus on your savings, especially for retirement. That's not going to stop. You have the time factor and the growth of your funds. So we always recommend that you continue to save for retirement, especially if you're offered an employer match. So if they're giving you a match for funds that you contribute, that's free money. You definitely want to take advantage of that. Or focus on savings if your savings is earning more than your debt is costing, which is, rare, but it can happen. You want to focus on debt, especially high interest rate debt, and debt if it's causing you stress or if the majority of your monthly income is going towards paying down debt and other bills. So it's really, important. The last step is to get everyone in the household on the same page. So if you're working towards paying down debt, you want to make sure your financial partners are all on the same page with you. If you have kids, get them involved in the conversation. You don't have to dig into too much detail, but just let them kind of know, hey, this is what our plan is right now. This is what we're doing. We're maybe cutting back on a few things. It's temporary. We want to take care of business. And you want to continue to monitor your debt situation. So you're tracking using, you can use an app, an Excel spreadsheet, whatever you want to use to help you kind of keep track, but you want to see the progress as you're paying down those bills. And of course, if something changes, you want to be able to adjust your plan as needed. So if you get, like I said, if you get a tax refund or a bonus at work, or if your income is increased or reduced, you're going to have to adjust that plan. So that's kind of the last piece. We also wanted to include some resources so you can follow up and learn a little bit more. Of course, our website, uvacreditunion.org. You can find information on GreenPath Financial Wellness there. The Federal Trade Commission, especially the consumerftc.gov website, has some great information on debt, credit, and money management. And of course, the CFPB. So we have a lot of great resources we recommend if you want to continue learning. All right, thanks everybody.